Today, we're going to talk about some things that are end of semester logistics and make sure we're prepared for next week's group project, final presentations, and papers that need to be submitted. But let me just talk to you about a couple logistics items that we need to finish up with first. So today you should have turned in homework 11. Also, group case 3 was on Friday. So one thing that we've done is, and for some reason, Elms is not letting me get to these assignments. Oh, there it is. It wasn't earlier. So this is section 301. So I put the presentation order for Monday and Wednesday up. So for section 301, it will be Walgreens, CVS, and HCA on Monday. And then next Wednesday, it will be US Physical Therapy, Acadia, and Tenet. Okay. So the way it will work is that everybody will turn in their presentations regardless of the day that you're presenting on Monday by 10 a.m. You'll turn in a PowerPoint file for the PowerPoint presentation, the Word or PDF of your written assignment, plus all your Excel models, 4 Excel models and all the exhibits. Basically, you'll present either Monday or Wednesday. 20% of your semester grade is this group project on this company. 12 of the 20 points will be your PowerPoint presentation, which you'll give on either Monday or Wednesday. The other 8 points will be your paper. Okay, so the PowerPoint is more heavily skewed on the grading, but they're going to be graded independent of each other, and all of the information for your group project needs to be in each document. So all of the 4 sections, which we'll talk about in more detail in a minute, must be in the PowerPoint. All 4 sections must be in the paper. If you talk about it in the paper, but you don't talk about it in the PowerPoint, you will lose points. If you talk about it in the PowerPoint, but you don't talk about it in the paper, you will lose points. So it's just 2 formats to present the same information graded independently, but nonetheless, they both have to holistically have the same information in them. Okay, so a couple more things about the presentations next week. Again, whether you're presenting Monday or Wednesday, everything has to be turned in by Monday. Okay, and that's going to be the information that you're going to submit. 10 a.m. is the deadline. Make sure you submit by 10 a.m. or really bad things are going to happen to your group. You don't want that to happen. All right, so a couple more assignments that are coming up. I did post this morning the final extra credit 2. Okay, so here in the extra credit, we had the assignment replacement. So again, the assignment replacement is something you need to complete by next week if you want to replace a missed individual assignment. Complete that one to replace it with the highest scoring grade. That will also impact your ability to opt out of the final exams. We'll announce that next week once everything is graded, who can opt out. And then extra credit 2 is worth 3 points. And basically, this morning, Marriott announced that they're developing an Airbnb competitor. So the extra credit, which is worth 3 points, is evaluation of Marriott, assuming that they're going to do the Airbnb thing. What's that mean? Give me the new buy, sell, hold based on that information. And you will need to do the multiples to basically figure out the productivity, because just like Yum, Airbnb uses a lot less investment than does a Marriott. So you have to start thinking about, will that affect their productivity going forward? So that's the nuance, but nonetheless, you're going to do an as is, a bull, a bear, and a target for Marriott, 500 words. That's the final extra credit. That's 3 points towards your semester grade, which means now there's 105 total points with this second extra credit available this semester. Remember, your grade is based on total points, not percentage of total. Okay, so to get an A in this class, you need 93 out of those 105 points. To get an A minus, you need 90. If you get a B plus, you need 87. The only thing that will be skewed is the A plus. Because I've given 5 extra points, 97 is not the threshold for an A plus. It will be higher. How much higher, I won't know until final grades come in. But nonetheless, this is the other extra credit. So if you are in need of extra credit points, do this extra credit. This is your other extra credit opportunity. Again, do Monday, May 6th, 10 a.m. Yes?
If you do have all the assignments and you don't get to take the final, do you get the automatic points?
Correct. Yeah, if you question was on the opt out for the final exam. So if you opt out and are able to opt out of the final exam, you'll just get the points for the final and you won't have to take it. And that's the way it'll work towards your grade. Okay? Yes.
Were they, like, I just remember at the beginning of the semester, weren't we allowed to have like 1 0 on the
Well, that's what the assignment replacement is.
Okay, so that's your chance to
That's your chance to make it up. Okay. So if you have a bad grade or a 0 or miss an assignment, I'm actually including it for one person who didn't do their Bloomberg certification. Okay. I don't know why. I gave everybody every opportunity to do it, but nonetheless, they didn't do it. So they're going to actually be able to use it since it's an individual assignment for their Bloomberg replacement. But nonetheless, any individual assignment, this does not count towards a group case, and this does not count towards an exam. Okay, but it does count towards the individual assignments. Okay. Other questions? Yes.
For the extra credit, do we need to do the multiple at the very end where we say? Okay.
Yes. Now, because that's now built into our final models, you got to do the multiple assessment and talk about why it's reasonable along the way. Good practice for your final. Yes.
And for the minimum grade for each of these, do you have a set number?
The minimum what?
The grade for each assignment, individual assignment?
Got to talk to the TAs about that, but generally 50%. Okay. All right. So, just as logistics. So the other thing that's coming up is your stock sim. Note that if you go here to the file section and you go to the Bloomberg folder, you're section 301, but you can look at your section, and this shows you the number of longs that you did in the first half of the semester. Right? By next Wednesday, you need to have 10 more than that on the long side. Otherwise, you'll be disqualified. Okay? And again, you can't have more than a certain amount of cash on hand. So as of today, if I go to this section under idea, just to see where everybody stands. So that would be the ranking as of today for this section. So again, just make sure you have done enough trades, 10 more than where you were in the first half. Okay, on the long. Shorts don't count. Okay, but nonetheless, you can see where we are today. This section's actually done pretty well. I don't count. I only made 2 trades. I'd be disqualified anyways from the first day of class. But this section is actually the best performing section out of all of them. So you guys are doing a really good job. But regardless, easy to do that when the market's up. But in any case, it's still tight amongst the leaders here. All right. Then last but not least, so next Monday is presentation week. So this Wednesday, which is, what's today? 28th? 29th? So Wednesday is the 31st? Sorry, just keep track of the days. So on Wednesday, you may, I'm not going to do a lecture, so I'm giving you time to work on both the extra credit and or mostly your group projects. So you're completely successful next week. So we posted last week the requirements for the group project. They are here under the announcements. This essentially, let's see if it pulls up again, because it wasn't pulling up in the earlier sections. Going back to the problems. This final project requirements is the grading template I will use, and it tells you what all your requirements are. In addition, there's an announcement that one of the TAs put up where he called it Final Project Tips. Because the TA had actually been in the class and done the project and got a grade, as well as saw what we did last semester, I'd strongly encourage you to take advantage of his suggestions to help you with your grade as well. Okay, so look at those two. But I'm not going to make this available, but to give you a sense of the PowerPoint presentation you're going to do next week, I'm going to show you what a group did last semester that got a perfect score on their PowerPoint. Okay, so at least you get a sense of what one of these can look like. But I will say, and this is very important, that for the PowerPoint presentation, there's a couple of rules that are going to be very important. Number one, you will be here on both days, the 6th and the 8th of May, all throughout the entire class, whether you're presenting or not. So if you're presenting on Monday, you're still showing up on Wednesday, right? And while you're here, you will be polite and respectful. That means computers and phones off. No clacking of the keyboards. The people that are presenting are going to be nervous, and it's for 20% of their grade. So I don't want you to be distracting them. Like, I have a different standard. I see some of you doing it today. Okay, I've lived with it all semester, but I will be a different standard next week. So while you're here, I know you're going to disconnect, but you're going to disconnect. You're going to sit and very respectfully listen. You're also going to be business casual dressed or minimum both days, whether you're presenting or not. So if you're dressed for the gym or dressed for Ocean City, I'm going to send you home, and you're going to lose your group project grade. okay? Or 5% of your semester grade if you're not presenting that day. I'm not going to let you present if you don't show up. So don't show up anything less than business casual. So he would not be acceptable today. He would be politely sent home. Okay. So what is business casual? Business casual could be jeans. Okay. It could be some form of shoe that's not a sandal. It won't be sweatpants. It could be like a polo shirt, a shirt with a collar, right? But nonetheless, you don't have to wear suit and ties. Even the groups presenting could be business casual if you want, but nonetheless, minimum business casual for everybody here in the room, both days, presenting or not, being very clear on that one. Okay. All right. So, in terms of presentations, as I said, I've already told you some of the teams will go on Monday, some will go on Friday. I'll be sitting in the audience. You will be presenting up front. I will have my iPad with a countdown timer. It'll have 15 minutes on it. Each team has 15 minutes. When the timer hits 0, you're done. No matter where you are on your presentation, you'll get a couple seconds to wrap up, but I will stop grading you at the point of the timer ending. I will ask at least one question to every group. Okay, that question will impact your grade. Okay, so for example, if you were presenting Marriott, I'd be asking you about, hey, what's going on with the Airbnb announcement today? And if you say, what Airbnb announcement, it would be unfavorable to your grade. Okay, so again, you got to be paying attention to the real world of your companies, and or I'm generally going to do it either on real world news, or I'm going to do it on, hey, that number looks really weird. Explain that really weird number. And if you can't, it's going to hurt your grade. So I'm just telling you, my source of questions are going to be really weird numbers. So if you got a giant amount of goodwill, I'm going to be like, all right, what's that number? Who'd they acquire? If you see a weird number in your multiples, why is it a weird multiple? So those are going to generally be my sources. I'm not going to try and trick you, but if it looks odd to you, it's probably going to look odd to me. And you should have an explanation for things that look like outliers. Right? So those are a couple tips for that presentation. For the presentation, I used to make every member present. I no longer do. So in terms of the presentation, you have 1 to 7 group members. You can have 1 to 7 people making the presentation, but whoever's presenting, the grade for the group is based on what they do. And you're still here for that presentation. Okay. So again, it's a 15-minute presentation. Now, next week, I'm also going to give a chance to do what are called peer evaluations on this and the other group projects. So in just a second, I'm going to go through the Volkswagen did the great job last semester, and you'll notice that in the first slide for Volkswagen, I think it's full screen. Actually, let's not make it full screen. That all the names of the teams were here. But a couple of teams didn't actually have all the names of the people that were presenting last semester. And they wanted to talk to me after class because basically they said, no, but they didn't show up and they didn't help in the group presentations. And so as part of the peer review, they lost 20% of their semester grade. So I'd like to see that happen to you. So what's going to happen is everybody's going to get the group grade unless you fill out a peer review saying that 1 or more team members did not fully participate. That's going to apply to this group project. It's going to apply to the stock simulation and or group case 1, 2, or 3. Okay, so if one of your team members, and I'm going to ask to submit on a scale of 0 to 100, what percentage did you contribute to the group as based on all the key members? If they say less than 100%, it won't affect your grade. But if 2 or more of your team members score you 0 to 100, less than 100, it will affect your grade. And so last semester, we had a team, we had 3 people who decided for whatever reason to not do the group project with the other 4 members, and it was bad for them. So I don't want to see that happen. That's why I'm telling you a week in advance, like if you don't know who your team members are and you haven't been working with them, like buy them a Chick-fil-A sandwich, take them to lunch, be nice to them, because basically they have your grade in their hands when it comes to these peer reviews. So again, I know most of the work's probably going to be done this week, but regardless, make sure you're participating with your team, right? Because that's going to be very important to your team grade. A couple more things. You're going to have 15 minutes to present 4 sections. Each section has the same weight, okay? So again, you think about the PowerPoint, which is 12 points. Each section is worth 3 points. If you run out of time, I'm only going to grade what is presented. I'm not going to grade what's actually on the screen. If you don't get a chance to talk about it, you don't get the points. So I'll just give you 2 things that tended to hurt people in the past. So hopefully you can avoid these mistakes. Mistake number 1, EIC I've seen run 8, 9, 10 minutes. And it's a hard section. There's a lot to cover, but you know what? It's only 25% of your grade. And if that person or persons runs 10 minutes and then you got 5 minutes to do everything else and not finish it, your grade's going to represent that, right? And I've actually seen a situation where they didn't even get to the valuation because they ran out of time. And again, I'll feel bad for you, but don't let that happen to you. And the other thing is they do the same thing with the historical analysis. I've seen people spend 9 minutes on CFI and the ROIC tree. I appreciated the thoroughness of what they've done, but as I said, they took up so much time, you couldn't get to the other sections of your report. So you have to get through all 4 sections of equal weight. So what typically happens is that if you practice, you usually practice your section, but you don't practice all 4 together. And when you put all 4 together, you run long and it's bad for your group. So my strong recommendation, at least once, practice a dry run of the entire group presentation with somebody with a timer and see where you end up, because recognizing you have 15 minutes. All right, it'll be a better presentation, and nonetheless, you don't want to have time working against you. So that's the first thing that can go awry. Right? The second thing that historically has gone awry is the inconsistencies between the sections. So somebody in EIC talks about what an awful industry it is, and it's going to be terrible in the future, and nobody's making money, and then the valuation is close to the bull, and it's a target price with great growth, and everything is expanding margins. And I'm going to be like, are they even talking about the same company here? Right? So make sure there's consistency amongst the 4 sections so it doesn't look like you just did them independently and slapped it together, because that's what tends to hurt grades. Right? So again, these should all be building and synchronous with each other. So again, recognize that as you're putting the pieces together throughout this week. So back to the presentation. I'm not going to be grading you on style points per se, meaning I'm comfortable being in front of a room just talking. Many of you aren't, especially talking for a big grade in front of a large group of people. So if you need to have notes, if you want to read off of 3x5 cards, perfectly fine. I'm not going to penalize you. In fact, I'd rather you read off of 3x5 card notes than not talk about important things because you get too nervous. Okay? Now don't get me wrong. If you're unintelligible in what you say, I can only grade on what I hear, and if I don't understand you, it's going to hurt your grade. But regardless, if you do need to refer to things, feel free to refer to things. I'd much rather you be comfortable and get that done than just say that you're so practiced that you don't need the cards, because if you get nervous and you forget something, that will hurt your grade more than if you know that you covered it because you covered all the things and check some boxes. All right, you'll be using the computer at the front of the room, so come a few minutes early to make sure that we load those presentations up and you're ready to go. But again, 15 minutes per team. And again, 3 teams will present on Monday, 3 teams will present on Wednesday. For the other sections, we have 4 teams presenting on Monday. The 4th team is the swing team. Hopefully we'll get them done on Monday. If not, they will all present on Wednesday of next week. All right? Questions about logistics of the presentation? All right, so what do you need to do in an ideal world? Who's presenting? The order of the presentations I gave. So whoever's presenting first in this section, who's the first team? Presentation order. This is section Walgreens. Where's Walgreens? You will get the worst grade of all the teams. All right, you got the bad draw. Whoever goes first is at a huge disadvantage compared to the other teams. All right, and you might think, why? Well, everybody else is going to be watching you, and they're going to learn from what your mistakes are, and they're going to learn from what you do well, and they're going to copycat what you do. It's just natural. So generally, the people that go on Wednesday tend to do better than the people that go on Monday because they have 2 days to recover and see what everybody else had done. So to mitigate against that, there's just nothing I can do about that. Here's the deal. Number 1, whatever you turn in on Monday is it. I'm not going to let you change anything in the documents you turn on Monday. That is what you present. And if you talk about things that are not on that PowerPoint, I'm not going to consider them. Number 2, you can't jump out of the file. So that means you can't jump to an Excel file. You can't jump to an exhibit. You can't jump to a website. Everything has to be in the PowerPoint. Only what is in that PowerPoint that was submitted Monday morning by 10 a.m. will be considered for your grade. Okay? More importantly, if it's in there and you don't talk about it, it can also hurt your grade. But make sure you put the kitchen sink in there. Otherwise, you're not going to get it graded. Same thing with the papers. The papers need to be approximately 2 to 3 pages per section. Okay, so 2 to 3 pages in EIC, 2 to 3 pages on historical, 2 to 3 pages, this is your guideline, on multiples, 2 to 3 pages on your valuation. That's 10 to 12 total, or 8 to 12 total pages. So typically 10 to 12 is where most people end up. So here's the deal. Plus exhibits. Right, you're going to turn in the 4 Excel files and all the required exhibits, which were on that list. But here's the deal. Don't make it impossible for me to find those numbers, because I got to read 26 papers very quickly next week, and I grade the papers, not the TAs. So if I'm searching around in your EIC section for a beta, I'm going to give up after 30 seconds trying to find this thing and just not give you credit for it. So very clearly, 2 suggestions. Put it in line, the screenshot of your beta when you're talking about EIC, or make it really clear where it is in the exhibits. Don't expect me to go searching through your document to find random files and screenshots. Okay, so again, just make it very clear when you do your papers. It will help your grades. All right, so all being said, what does a good one look like? This was a group that did a good job last year. So they did it on Volkswagen. First slide. Here's my name, teams, sections, and the company we're doing. Again, I liked it. They did an agenda. Here's the 4 sections we're going to cover. All right, you don't have to do that because I know which sections you're going to do, but generally it's easier if you just go in this order. And by the way, don't really change this up dramatically. It's easier for me to grade you if you kind of follow the process we use in the class. Okay. Second, then they added, which I liked, and a lot of teams did this last year, right up front, here's our recommendation. Here's the buy, here's the current share price, here's our target. Okay. This is 10 seconds, but it frames what I'm about to see. Okay. Also, they did this on November 30th. So most likely you're going to be presenting either on the 6th of May or the 8th of May, but you're probably going to do your valuation this week. So therefore you can say, I did my valuation on May 1st. Okay. And make sure that you do your multiples and the valuation on the same day. You don't want those multiples to be out of sync with your company's stock price. Right. But nonetheless, you don't have to redo it Sunday night. But if anything dramatically changes over the weekend, at least be aware of it, but you don't have to redo your valuations. Okay, so continuing. First section was EIC. Here's the screenshot for beta. Here's the information about the economic impact. Okay, and again, I just like this. It's all on one screen. Okay, same thing. Here is the I. These are my 5 forces today and in 5 years. And here is my RV showing my industry spread based on operating ROIC. Okay, so again, I got my screenshot and I got my 5 forces. Now, some teams went further into explaining each of the forces in the tables. Other teams just did the summaries, because if you did the summary, you still got to talk about why some of the forces are important or not. But nonetheless, I can clearly see you did in the future and today each of the forces, and I can see the industry screenshot because you're explaining the spreads. Okay, very important. Make sure you refer to numbers. That standard applies to this presentation and your Word document just as much as every other assignment. If you go through here and you are general, you will get a 0 for this section if you don't talk about any of the numbers and you're just vague. So you can't just say, this is a good industry and the spreads are positive. All right? That is a worthless statement to me, and it won't get any credit on your presentations. All right? For the C, same thing. Refer back to the screenshot. There was the competitive advantage and an explanation for competitive advantage for Volkswagen today and into the future. Section 2, historical analysis. There's the tree. You got to walk through the tree. Okay, got to walk through the first level of the tree, tax rate, margin, productivity. Got to walk through the second level of the tree, what drives margin, gross margin, SG&A, depreciation, what drives productivity, working capital, PP&E, and intangibles. Right, and I'll just tell you, practice. Like I'll give you an example of what's not a good grade. Is it's clear that somebody didn't bother to do any prep. They're looking at the screen, they're squinting to find the numbers, they're like, okay, it looks like Volkswagen's ROIC went from 5.4 to 5.8, and that was better. So now we're going to talk about whether the cash tax rate did this. And I'm just telling you, it's actually a disservice to the rest of your team, because as you're crashing and burning this section, because I'm thinking you didn't take it seriously and you didn't even bother to do analysis except look at the picture while you're doing the presentation, it's going to kill the grade of your entire group project, and it's going to kill your whole group. So just don't be that person. Like, just come prepared. with the data. And it's clear when you're not prepared and you're reading numbers off the screen. So back to this. CFI. You also have to do a CFI. And unlike previous assignments, you also have to cover the intervening years. So again, standard. You're not going to have time to do all 5 years and all the data because, again, you got 3 minutes to cover both slides. I've got 90 seconds here. So what this team did that I liked is they highlighted in yellow a couple of key items from the other years, but you at least cover the 4 sections. Operating, free cash flow, cover non-operating cash flow, debt, equity. Here's some total stuff. Here's a couple of interesting things that happened in a couple of the different years. And more important, like why. Don't just give me a big number. Explain why that number was context, became a big number in the real world. Section 3, multiples. The difference in the multiples is, in your last assignment, you had 4 companies. Your group project, you're going to have 6. Okay, so there will be 6 companies, yours plus 5 others. I'm going to let you choose those 5. So unlike in the last assignment, I was somewhat prescriptive. This one, I'm not going to be prescriptive. You choose who your competitors are. Now, don't get me wrong. If your company is CVS, I don't expect Walmart to be on this list. I'm not saying that Walmart doesn't have a pharmacy, but nonetheless, I wouldn't consider Walmart to be a peer of CVS. So find realistic peers, but nonetheless, you need 5 plus your company and an industry average. So the market cap weighted average is your industry average because the premium or discount no longer applies to just your peers. It's also against the industry. Now, there are companies that are in your industry list, the RV screen, that won't be on this table. So this isn't the average of the 6 companies. This is the industry average of the segment that you just chose. And whether you use BIX or GIX or analyst curated, I will leave it to you because at this point, you should tell me who the peers are. I shouldn't have to tell you who the peers are. So that's part of this group project. Okay. When you go through this, again, you don't have to do it this way, but what I liked is they just kind of took the template, they went through the PE, and they talked about, and this is the key, you got about 3 minutes. So a couple companies, premium or discounted your own, and maybe the industry average. You don't have to go through all 6. And they do the same thing with the EV to EBIT and EV to sales multiples, maybe mentioning productivity along the way. Okay, so you got about 3 minutes to go through this. 3 or 4 minutes, which then leads to final section, the evaluation. So again, in the PowerPoint, you won't be able to jump to your Excel file. So this is how the team solved it. So what they did is they took 2 screenshots, one from the ratio screen, one from the assumption screen, and they had the other box of their key assumptions that they changed. So it was really clear for their as-is what they were doing with their as-is. And they repeated this multiple times. So here's what we changed for our bull. So it's very clear about the changes they made, and they just summarized them. And I could see it from the Excel model and then the share price impact. And then they had a little bit more detail here. They also did a sanity test on their bull to show that the bull was not a crazy bull. Okay. Same thing with the bear. Here was my bear. Here's my assumptions. Here was the other reason for the bear. Now, they didn't do the sanity test on the bear. It would have been nice if they consistently did it through. But nonetheless, here's my bear. Here was my target. And my rationale for my target. And more importantly, here's my overall sanity check for the as-is, the bull, the bear, and the target. Okay. Now, I'll just tell you, standard-wise, I'm lowering the standard this semester. We're the only sanity test. Everybody will do a sanity test. But the only one I really need you to talk about is the target. Like ideally you do what they did and you talk about all 4, but if you don't have time and you're not going to have time, you at least have to talk about the target. Now here's the deal. If your target is a hold, it's easy because you basically say it's reasonable by definition. There's my sanity test. This is reasonable because the multiples are going to be pretty much the industry multiples. The only time you're allowed to talk about this is if you do a bull and a bear. So because Volkswagen was a bull, they had to at least explain why it was a reasonable multiple range as part of their bull. That would have been the final part I'm looking for. Okay. So again, this is what you're going to do. This was a good presentation. Obviously make it your own, but it gives a sense of what I'll be expecting next week. Questions about any of this? Okay, great. All right, so that will be the presentations. So again, next week, Monday, Wednesday presentations. By Wednesday, we'll tell you who's opted out and then that following Monday will be the final exam. All right, so today, a couple more things I want to talk about. Briefly, I want to talk about group case 3, which I heard actually was somewhat graded for some of the sections already. Where is group case 3? All right. So, again, back to the McKinsey case here that we were going through. So the key to group case 3, first was getting the math right, and then understanding one of the core concepts was why this industry was at equilibrium in step 1. So what the TAs are basically checking for the math is, did you get the right economic profit, both sort of on new equipment and on salvage value, and did you get the right perpetuities? So if you got these 6 numbers, that's what they're going to be looking for across the first 4 worksheets. So negative 155, 0, 640, 450, 600. Right? So basically, the real question you need to answer here is, with this data, when you looked at the original case, the integrated players are destroying $155 per ton of value. Why wouldn't they just shut down? Why would it make sense for them to keep operating despite the fact that they got ugly numbers? What's the reason? What'd you guys say, based on the information on the case? If you're losing so much value here, why not shut down? Anybody have an answer to that one? Yes, sir. Yes. So can you translate that into English?
It costs more to try and sell the brand than it does to continue operating.
Yeah, it's a good way of saying that. So the answer he gave can be arrived at one of 3 ways. And this is actually an important point. The reason that there's 2 views on this page is the top half of the page, the return on new equipment, is basically the book value or the accounting point of view. And on an accounting basis, the integrated player is in a bad spot. Based on what was originally spent, they're destroying value. And that's based on the balance sheet. But what we learned in Finance 101 is the concept of sunk cost. Once the plant has been spent, there's nothing we can do about what we originally paid. We can only make the best decision from today forward. And today, the plant has a market value of $390 per ton for the integrated players. When we put it in, we spent $2,000, but today it's worth $390. That's what the salvage value tells me. So here's the point. From an opportunity cost of capital, our investors want to make 10% on their money. Okay? What's 10% of 390? 39. So basically, if I look at opportunity cost, I have a plant worth 390. They expect me to make 10% on it. I'm making, that's 39. I'm actually making 45 at this price point. I am $6 per ton better running the plant than shutting it down. That's the conclusion he arrived at. Let me say it a different way. I make $45 per ton. I have a plant that's worth 390. That's an 11.5% rate of return. I'd rather make 11.5% than 10. I know the accountants say it's something different, but that's just paper. I'm talking about cash. Let me say it a third way. If I make $45 of cash per ton and I keep doing it over time, that's worth in perpetuity $450 in present value. Would you rather have $450, or would you rather me sell it today and give you $390? I'd rather keep running for the $450. There's 3 ways of saying the same thing. I am better off running the plant than shutting it down. And that is a very important insight that a lot of people miss when they look at companies. Why do airlines run for years so unprofitably, right, before they change their business models? And the answer is because what are you going to do with a plane when there's oversupply? You're going to sit it in a desert and park it. Well, if I can make more money flying it, which is basically a fixed cost, at basically covering fuel and labor, why not operate it and get something out of it than sitting in the desert and get nothing out of it? Okay. Why do other industries run with excess supply? What's the explanation for the auto industry and their poor performance today? Because they have a bunch of fixed costs from years ago that look terrible on their books, but it's not incremental cash that they're spending. So it's better off running than selling. So as a matter of fact, I was drawing a picture, but if you think about it, I'll try and draw it on the screen. See if I can do this. Blue. See if this works. No. Draw a line. Try and draw a line here. Think of it this way. If this line here if this line here is your WAC, call it W, and this line here is your ROIC, this is the negative spread. This is the zone of pain, is what I like to call that. You're destroying value, but you can keep operating. When you get down here, sorry, the drawing tools are not ideal. When you get down here, this is the salvage or market value. So you don't go out of business until you run here. Let me say it a different way. If this is your WAC and this is your ROIC, you can keep operating, but if this is your cost of debt, you can't go below your cost of debt long term. You can go below your cost of equity long term, but you can't go below your cost of debt long term because the banks will actually seize your business and shut you down. But you can go a few quarters or even a few years or sometimes a decade of underperforming to the shareholders and keep the business running. The shareholders will keep going. Look at Sears. They've been doing it for a decade before they finally threw in the towel. And even then, they went through bankruptcy and reorganized, right? But the point is they went through a long time of pain because they were headed negative spread. But at some point, when you can't even cover your cost of debt, or it's better to liquidate than shut down, that's when investors throw in the towel. And that's what we're representing in the case here. Okay? So just because you're underperforming doesn't mean you go away. Look at what's happening right now with JCPenney. They're now in that zone of pain. And then the question is, how long before they either get out or hit that other point where they're going to have to shut down. But while they're in the zone of pain, they're going to keep operating, destroying value, even though their numbers look terrible, they're going to keep going. That was one of the key points of the case. Key point number 2, why didn't Nucor take advantage of this? Why didn't Nucor just build another first generation mini mill? Why did they need to have a second generation mini mill? What's the answer to that question? On this page, why not just expand capacity of the first generation mill? Because they're making $60 per ton here, and they're not destroying value. Yes?
Is it because the ROIC is the WAC?
Because we're at a zero NPV, why not just add a zero NPV mill? It's actually something even worse. It's not just you're not making anything. What happens to the price when we add any capacity? It goes down. So our zero NPV actually turns into a negative NPV project. So back to the top half of the page, if the price goes below 500, the thin slabs don't create any value, so it doesn't make sense for them to add capacity, right? And the integrateds at 500 destroy value, but not enough to want to shut down. So that's why the industry is at equilibrium. And that's just an important insight I need you guys to have. Now, step 2 is not a necessary step. Step 2 is just an iterative step to prove a point. And McKinsey did it just for a learning benefit. So here's the point. You add 5 million tons for the new plant. It drives the price down to, you just look at the supply curve, to 480, supply demand. Okay? So essentially, just look it up on the curve. That would be the new price of steel, 480. So at a 480 price, does the world change for the integrated players? Yes.
Yeah. Integrated's left, right?
Integrated is the one on the left.
Yeah. So they would leave the market
Why? What number tells you they're going to start leaving?
because they're suffering losses due to their EP.
What numbers are you looking at?
No, -6. And
The -6. So they are $6 worse per ton staying than leaving. That's where the world changed. And the reason why is because the price went down. Okay? What's another way of saying the same thing? There's 3 ways you could have answered that question. He answered one of the 3, the -6. What else tells you they're going to leave now? Yeah.
The value of all future cash flows is 330, which is less than the salvage.
Yep, the 330 being less than the 390. Take the 390. What's the third way? You're now making 8.5%. And you wanted to make 10. All 3 indicators, again, rearrange math, are basically telling you now it makes sense to leave. And that was the whole point of step 2, is that in step 1, we're kind of like in a painful zone, but we'll continue. Step 2, we're now at a point where it makes sense to throw in the towel. But it's interesting. I don't just shut down completely. What I do is I shut down some capacity, allowing the price to rise until it doesn't make sense to rise. That's the answer to step 3. What's that price point in step 3? What's the step 3 price? $490. You should have solved for a $490 price. And the way you solve for a $490 price is you set this to 0 and you work backwards. Because they're going to shut down until they basically have no incentive to shut down. They're going to shut down when they're indifferent between staying and leaving. That's when their profit equals their capital charge of 39, or when the future cash flows 390 equals the salvage value of 390. And that price point is 490, and that becomes the price of steel. And so the real question is, at 490, will we make money with our second generation mill? And the answer is yes, because we get a 12% ROI on a 10% cost of capital and a positive NPV. So first thing, and the reason for this case, was that we had the idea of understanding why there was no incentive for the first generation technology to expand and why the integrated players didn't leave. Second lesson from the case is that a common mistake people make in forecasting is they leave the price alone. They leave the price of steel at 500, or worse, they leave the price of steel at 500 plus inflation. And what McKinsey is actually showing here, especially commodity-based industries, is that price will go down. And they advocate for what I would call ROI-based pricing, which says, if I make a 10% ROI and nothing changes and about the ROI in the future, about the 5 forces, then if my costs go down, my price goes down. So let me say it in context of Marriott. What's happening to the supply of Airbnb-like products when Marriott dumps a bunch of supply in the marketplace today? What's going to happen? What's going to happen to the price? It should go down. So in a way, Marriott entering this marketplace is going to add a lot of capacity, theoretically, if they're successful, and that should actually lower the price for vacation rentals or overnight rentals in that marketplace. Because in supply and demand, now I don't know how elastic the curve is, but Marriott coming in should actually help lower the price initially. Okay, and so that should be part of our thinking in terms of the marketplace, because if we don't think that if they double supply and nothing happens to demand, that price isn't going to be impacted, then we're just missing the point. And a lot of people do that when they do these DCFs and project finance. So that's the point. If I left the value at 500 a ton, not 490, and I didn't foresee the price going down, I would have overvalued my project. But here's the next thing. Nothing lasts forever. We're the only game in town for the first 5 years. Starting in year 6, will somebody build a strip casting plant? Yes or no? Based on this data, will somebody build a new strip casting plant? What tells you they will? What data on the screen tells you they're going to build a strip casting plant? Yeah. Yeah, exactly. So I want that. So I'll go build a plant to go get that. Except as I build plants, price is going to go down. So when will they stop building? At what price point? And what's that price? Because that's the answer to step 4. $475. So what's interesting is when you go in, this is the driver. When you go out, that's the driver. After you're in, thinking about exiting. That's the other key lesson of the case, just Finance 101 at work here. This is the concept of sunk cost. But in the real world, it gets very confusing to people. But here's the point. We have 2 price points. First 5 years, the price is $490. Second period, year 6, price falls to $475. Now we do our DCF. For the second generation mill, we make 54 a ton for the first 5 years. NPV that, it's $1.024 billion. When the price drops to $475, we make 45 a ton times 5 million tons. It's $225 million. NPV that, $13.97. So when I do my DCF, $1.024 billion of value in the first 5 years, $13.97 in year 6 into perpetuity. Spent $2.25 billion today. NPV about 171, 172. That would have been the solution to step 5. Now, we didn't talk about this much this semester, but in previous semesters, I used to have a second valuation model where we do an economic profit or EVA-based valuation. Stop doing that. It was just a little overkill given how much we had to cover. But here's the point. The valuation doesn't change when you use these different approaches. They're the same. And an economic profit, also known as EVA, economic value added valuation, gets you the same answer. The difference is NPV tells you how much value you create. Economic profit tells you when the value is created. And that can be insightful. So anybody go work for Stern Stewart? This is what Stern Stewart does. So in the first 5 years, they make $9 million from step 3 of profit per ton in that new mill at the $490 price. Times 5 million tons is $45 million a year of profit. Starting in year 6, when the price drops to $475, they have 0 economic profit. So the DCF tells me all of the value is created when? This project's going to make $171 million, $172, depending on rounding of value. When does the value get created? Why in the first 5 years? What's the big difference between the first 5 years and year 6? Yeah. It's not about supply. It's about the competitive advantage. We have a competitive advantage in the first 5 years. We're the only game in town. We're achieving above average returns. We have a positive spread. When competition shows up, we lose our spread. Spread goes to 0. We don't create any value. We generate cash flow, but no value. So I want to value Pfizer. I'm going to value Pfizer, pharmaceutical company. What matters to my valuation of Pfizer? What's critical? Yeah. Patents. How much drugs do they have under patents, and when do those patents expire? Do that DCF, and that's the value of Pfizer. Everything that happens after the value of the patents expire is like steps 2. It's that period of time when the generics show up. You get the price point that's high under patent. Generics show up, price goes down. NPV 0 when the generics show up. So the value of Pfizer is basically how long under patent protection. So if I'm doing a pharmaceutical firm, here's the basic math. 17 years, I think, is the use life of a patent in the United States. You patent it when you start working on the molecule, not when you release it to the marketplace. It takes 10 years to do R&D. So how much time do I really have to value in the real world? I got 7 years worth of cash flows. That 7 years worth of cash flows is everything. So if I'm talking to Pfizer's R&D team, how do I tell Pfizer's R&D team how they can impact value for Pfizer? Yeah, speed up. Get it out there in 8 years. Because if I get 2 more years of patent protection, I generate a whole lot more cash flow. And it's not 2 years after I lose the patent, because that's NPV 0 cash flow. It's 2 years under patent, which means if I can get 9 years of patent versus 7 years of patent, that's going to add a whole lot more value to my overall drug. And I'm just telling you, this repeats industry after industry after industry. So the point is, the real value is created, and this is under the key value driver formula. We called it sustainability, time to maintain competitive advantage, because it's that competitive advantage when you have the advantage that value is truly created. When you don't have competitive advantage, you can generate a lot of cash flow, but you don't create a lot of value. And that is what becomes critical in understanding the way that the market works. Okay? By the way, final step 6, productivity. Basically, I asked you to do the math for this one, but you didn't have to write it up. But this is cannibalization. We have a first generation mill that produces 500,000 tons of capacity. Basically, what happens here is that they're going to lose $6 million of profit when the price drops for the first 5 years. Well, that works out to $3 million of lost cash profits per year. DCF that's $11 million. Starting in year 6, we don't worry about it because that cannibalization is no longer incremental. When anybody can do it, I don't count it against my business. Okay? So therefore, I have 171 million. I lose 11 million by self-cannibalizing my own plant. And so therefore, I end up with 159 million. Right? So here's a question about cannibalization. I've worked with a company called basically the people that make Invisalign, the things that go in your mouth. And I'm sorry, Align Tech. And they sell those Invisalign things. Okay? But here's the thing. They sell them primarily through doctors. So you got to go through an orthodontist, whatever they're called. And basically that's where you're going to get that. Okay? But here's what's interesting. I did a demo working for their senior leaders where I was a secret Santa customer and I went through their Montgomery Mall branch and they do a 3D scan for free. And what I found is that they can actually use those 3D scans to go directly to you and they don't really need the doctors. Right? They only went through the doctors because basically that's the way the market got started. Now, there are competitors now to Invisalign, Smile Direct, and some other companies that are not going to the doctors, and they're going direct to customer. So here's the question. Is that cannibalization? If they were to do a direct to customer model, and they don't go through the doctors anymore, they just like Smile Direct, they scan you and they send it to your house, which is basically what Smile Direct says. It says you don't have to see a dentist for this. We'll just send it to your house and you just replace it yourself. And they get into that business. Is that cannibalization? Because that's hurting business that's going through the orthodontist. Yes or no? Is that cannibalization?
I think no, because it's not a different product, it's just a different channel that they're distributing through.
Well, let me ask you this way. Are they going to lose that business to Smile Direct and their competitors anyways? So it can't be cannibalization. See, the key of the cannibalization conversation is it incremental. And so when we do it to ourselves and we're the only game in town, it's actually incremental. If it's happening competitively, then you can't call it cannibalization. That's why we only do it in the first 5 years and we don't do it in year 6 going forward. I didn't ask you to write this up in the case, but I wanted you to at least understand that point. So there's a couple of key points here that are very critical. But the first one is price doesn't stay static into the future. And a lot of people tend to forget that. Number 2 is that there really is this notion of 2 views of a company and industry. There's the view of when you go in, you got to earn full freight. But once you're in, that goes out the window and you have to change your point of view to say what's best on an incremental basis, and sunk costs no longer apply. And accounting statements confuse those decisions. And that's what's showing up here. There's a lot of industries that struggle with that. Okay? And then number 3, this is about productivity. Let me tell you why this is about productivity. If we had done a simple spreadsheet and I looked at just step 3. So this is just step 3 of the case, and this is first and second generation Nucor. If I looked at their margin, which was profit divided by price, they made 54 divided by 490 price. Both mini mills made 11%. The old mini mill and the new mini mill. First mini mill made a 9% ROIC, 54 in profit divided by 600 of invested capital. Second mini mill made a 12% ROIC, 54 divided by 450. Positive spread, negative spread. Changed the world. The negative spread went away. We said this is a terrible business. The world moved to the positive spread. Why? Productivity. When you guys go through the ROIC tree and you talk about that random productivity number of basically invested capital per dollar of sales, you're like, why am I even bothering to do this other than Professor Perfetti said I had to? Well, what this case illustrates is how this was a game changer to the steel industry because Nucor completely changed the game, not because their margins were better, but because their productivity was more efficient. Because they only had to put in 450 to build a plant where my competitor was putting 600, and that got them a better ROIC at the same price point because their productivity was 92 cents per dollar and their competitor was spending $1.22 to generate a dollar. And what I'm telling you is that became a huge source of competitive advantage. And increasingly, productivity is a competitive advantage. Think about it in retail today. Why is Macy's struggling so much? Just think about Macy's, poor Macy's. Why is Macy's struggling so much? Why is JCPenney struggling so much against Amazon? Does Amazon have any stores? Does Amazon have as much inventory? Is Amazon's inventory just sitting on a shelf somewhere unsold for 6 months? Do they have all these physical mall locations all over the world? So that's the point. Amazon doesn't have to spend as much to sell the same products. So if I buy the same pair of jeans from Amazon that I do at Macy's, Amazon could sell it to me at the same price, and they can have a better return because they don't have all the capital infrastructure in their supply chain. This is the game changer that's happening in the world today. This is why, for example, Marriott Airbnb. This is the extra credit. Why is Marriott going after the Airbnb model? What's physically changing about their business? What's the fundamental difference? And I'll give you a hint. It's all about productivity. Yeah. Exactly. Airbnb doesn't have any assets. Marriott's got to go build physical assets every time they want to put you in rooms, and they are at a competitive disadvantage. We learned our lessons with Uber. Uber came around and said, I don't need to buy the cars. I don't need to buy the medallions, the taxi medallions. I don't need to hire the people and deal with all that labor. I'm just going to match everybody else at a lower cost and destroy the taxi industry. Airbnb is now destroying the other industry, and it's all not because of price. They're doing it because they don't have the assets. And so that's Marriott's model. It's like, look, we got to find a way to make money without building hotels because our competitors are eating our lunch, and we saw what Uber has done, and now Airbnb is doing the same thing to us, so we have to come up with an alternative. That's why Marriott's doing this. They don't have a choice. But this is not about margin. This is all about productivity, but productivity is transformative to certain industries. Matter of fact, the next industry you're going to see this drive through is autos, right? And the way it's going to drive the industry is you, when you get to my age, are not going to own a car. What are you going to do? I paid a lot of money for my car sitting in that garage. That's sitting in that garage all day long. What's going to be the difference? What's your generation going to do with cars? Yeah, it's utility pricing. It's like the cloud. I'll use the car on demand. And that says the same points. It's just like you go all these cities now and you see the bikes on demand and you see the scooters on demand, cars on demand, same thing. That's what you're going to have in the future. Why do you need to own a car if you can just get it when you need it and only pay for the utilization? That's where the market is going because that's a much more efficient model. And basically the car companies are worried that's what's going to happen to them. That's why General Motors invested so much money in Lyft. Right? It wasn't to basically make money on the IPO. It's we got to figure out how to be in this market when people go from ownership to basically renting and hiring us as a service. Because we clearly don't understand how to do that at General Motors for the last 100 years. And that's the way the market is starting to move. And Uber is just the tip of the iceberg in the way the economy is moving. And so, again, I was talking to somebody, is they're saying the same thing is happening now with clothing. There's a company out there, anybody not familiar with this? I forget what it's called. It's something closet is in the name. But literally, you can actually have the clothes in your closet, and you can put them online, and people can basically buy them from you. So it's things like eBay for clothes. And the whole idea is that you buy these clothes, they're sitting in your closet, you wear once, and you never wear them again. You just got a lot of inventory sitting in the closet. So the whole point is, how do we go with the utility-based model, which is much lower investment, to resell clothes, rather than to basically just sell new clothes that you wear one time. And now certain clothes, obviously you're not going to buy from other people, but others you might. And so essentially, this is starting to be looked at by the retail industry, to say, is this something we need to get worried about? Because if whether consignment or whatever you want to call it starts to catch on for clothing, that's going to be a game changer for people that are trying to sell you shirts and sweaters and jackets and jeans. But beyond the scope of our class, but the point is productivity starts to matter. That was the other key lesson for the case. All right, so let's go back to next week. Questions about the case, questions about the PowerPoint. All right, let me mention Nokia very quickly. So you had to do a Nokia assignment today as part of your final homework where you're putting the bull and the bear into your model. I just randomly picked a student's file that was submitted today, and this was their bear. Okay, so this was a file submitted this morning for homework 11, and I just picked up their bear case. The student doesn't matter. The section doesn't matter. This was just their data. Now, here's the thing. This is the multiples for their bear, and this was the market average and other companies in the assignments. Is this a reasonable bear? So I'm going to give you a metaphor while you answer that question, because this is how your grades are going to be determined and what you got to do next week. Is that in the U.S. justice system, there's two parts if you're going to be guilty of a crime that's going to happen. First is there's something called an indictment. And the point of an indictment is they use it on what's called a preponderance of an evidence, meaning 5149, does it look 5149 that you could be guilty? They don't make a decision whether you're guilty, but it's just like if there's a 51% chance that you could be guilty, then they'll indict you. That's the standard they use. But if you actually go to trial, the trial standard is much higher than 5149. The trial standard is beyond a reasonable doubt because I don't want to put people in jail for 51%. So it's a much higher standard. So I want to use that metaphor when it comes to the sanity check. So the first part of the sanity check is you have your multiple and you got the industry multiples. Does this look reasonable? Are we in the 5149 that these multiples can be achieved and reasonably given what we see in the distribution of multiples of the industry? Yeah.
I'd say yes, because the model multiples are like within the range of like the low and the high.
So therefore, I don't even need to talk about my sanity check any further than that. I'm good. I don't have to go to beyond a reasonable doubt. That a preponderance of the evidence says this bull doesn't look like a crazy bull, or this bear doesn't look like a crazy bear. Was this a bull or a bear? This was the bear. So this bear doesn't look too crazy, right? But here's the thing. Let's say it was beyond what we saw in the industry. Then you got to go beyond a reasonable doubt, and then you got to explain to me why. Why is my bear so much more vicious than what everybody else is, even the poor performance of the industry, is going to be in the next 12 months? What am I seeing that nobody else is seeing? So I'm not saying you can't be right or wrong, but I'm telling you at that point, your standard for convincing me that this is a sane analysis goes way up. Okay, so I'm not saying that all of your answers need to be like 1 or 2 standard deviations from the mean, right? Because that's what this inference works out to be. But what I'm also telling you is if you go multiple standard deviations from the mean, you better have a good explanation. Because if I'm trying to convince an investor that Nokia has this much downside, then they have to believe that it really has this much downside, and it's within the realm of possibility based on the information I have today. All right, so that's the point of the bull and the bear, is it's a sanity check. It's not an absolute value because, again, every now and then an asteroid could hit Earth tomorrow and kill us all. I can't say it's going to happen. I really hope it doesn't, knock on wood. But nonetheless, it's hopefully a very slim possibility. So I can't put that into my analysis. But nonetheless, I need to put in analysis what is realistic. Yes?
If you were to perform a bear analysis on something like Tom, Seal, and then
Yeah.
already on the line.
That one becomes harder because those companies that are, and we did not pick companies that were not established in our group project, but if I do an earlier stage company or companies at the margin, then their bear scenario might be going out of business. So for example, if I were doing JCPenney, like the JCPenney scenario for the bear is they liquidate, they follow Sears right out the door. I think that's a reasonable scenario in the next 12 months, that they don't make it through Christmas of next year. Right? So essentially, we have to be realistic given the companies that we have chosen, but no one has chosen in this section that I'm aware of or any of the other sections, companies that are at the margin, with the one exception of Tesla. All right, and I'm just telling you, Tesla's bear scenario got worse after Tesla's announcement last week because two things that we talked about earlier semester have now come to pass. Number one, they can't build the damn cars, and they finally had to admit that. And number two, they're running out of cash. That despite what Musk has said, they're going to run out of cash, and now they have to do a giant capital raise. And this should not be a shock to anybody, but nonetheless, this is now front and center in front of the institutions. And people are saying in the paper today that they're going to raise the cash, but they're going to raise it at a much higher cost. But that is the point. There's a chance if he goes crazy again, people may not want to give him the cash. So, like I said, it's not beyond the realm of possibility that Tesla doesn't exist in 12 months as we know it. Okay, something could happen, and one could be acquisition. So that would be a much more complicated scenario. I'm going to say you guys are running in that scenario, except for the poor team that chose Tesla in the next section. They're going to have to deal with that stuff. But regardless, it's a realistic bull and a bear based on the information that we have. All right, other questions about this? So again, giving you Wednesday to work on your group projects and or the extra credit assignment. I'll see you 1 week from today, dressed minimum business casual. Everybody will be in here, happy, ready to go. Kind of excited about the presentations because it's my chance to learn a lot about these companies and industries. So looking forward to hear what you have to say. Okay, see everybody next week.
Right now, I haven't gotten. Also, Professor, what do you think we're going to do?